Hey guys, good morning. What's the fastest way to turn a $5,000 account into an $800 account in under a month? You don't need a crash. You don't need a scandal. You just need to make a couple of the same mistakes almost every new options trader makes. You're about to see 10 of them in the order that actually cost people the most money, and by the end, you'll know exactly which ones to fix before you place your next trade. Some of these are going to sound obvious once you hear them, and that's actually the problem. They're obvious in hindsight, but almost nobody catches themselves doing it in the moment, because in the moment, it just feels like a normal trade. Options aren't dangerous because they're complicated. They're dangerous because they're forgiving right up until the second they aren't. You can make 3 or 4 small mistakes in a row and barely notice. Your account dips a little, you shrug it off, and then one trade combines 2 or 3 of these mistakes at once and takes a real chunk out of your balance in a single afternoon. That's the pattern behind almost every account blow-up story you've ever heard about. It's rarely one dramatic error. It's a handful of small habits stacking on top of each other until the math finally catches up. So think of this list as a list of rules and more as a list of habits you're trying to build before they cost you anything. Mistake number 1 is buying options with no plan for what happens if you're right. Say you buy a call on a $50 stock. Strike price at 55, and you pay $1.20 for it. So your total cost is $120 once you account for the contract multiplier. The stock climbs to 58 and your option is suddenly worth $3, a nice $200 profit on paper. Most beginners just watch it because they never decided in advance what their exit looks like. 2 days later, the stock drops back to 53 and that profit is gone. And now you're staring at a contract that's worth less than what you paid for it, wondering if you should have sold when you had the chance. This happens over and over because people treat a winning trade as a reason to keep waiting for more instead of treating it as a decision point. The fix isn't complicated. Before you ever place the trade, write down the price where you're taking profit and the price where you're cutting your losses, and then actually follow it, even when the position is green and every instinct is telling you to let it ride. Mistake number 2 is ignoring how fast time decay eats away at your option's value. Every option loses a little bit of extrinsic value every single day it holds, and that decay speeds up dramatically in the final 2 or 3 weeks before expiration. This is called theta decay, and it works against you no matter which direction the stock moves. If you buy a call with only 12 days left because the premium looks cheap, you're not getting a discount. You're buying into the period where decay is working against you the hardest. A contract with 45 days left decays much more slowly than one with 10 days left, even if the stock doesn't move an inch. Picture 2 identical calls on the same stock at the same strike, one expiring in 3 days and one expiring in 45 days. The 3-day contract can lose a third of its value in a single afternoon of sideways trading, while the 45-day contract barely notices. If you're new to options, giving yourself more time until expiration is one of the cheapest insurance policies available, and it costs you nothing extra to ask for it. Mistake number 3 is trading options on a stock you don't actually understand. It's tempting to jump into whatever's trending on social media or whatever a friend mentioned over the weekend. But if you don't know why a company's earnings might beat or miss, or what's driving the stock's recent move, you're really just gambling with extra leverage attached. Your account doesn't care how confident you feel. It only cares whether you were right. And you're far more likely to be right on a company you've actually researched. This doesn't mean you need to read a 100-page annual report before every trade. It means you should be able to explain in 1 or 2 sentences why you think the stock is going to move the direction you're betting on. And if you can't do that, that's usually a sign you're trading on excitement instead of information. Mistake number 4 is going all in on a single contract. If your account has $2,000 in it and you put $400 of that into one options trade, you've just risked 20% of your entire account on a single bet that has an expiration date. Professional traders typically risk somewhere between 1 and 5% of their account on any individual options position, specifically because options can go to zero in a way that stock ownership usually doesn't. Think about what the 20% bet actually means. If it goes to zero, and options absolutely can go to zero, you now need a nearly 25% gain on your remaining balance just to get back to where you started. Small position sizes aren't about being timid. They're about staying in the game long enough to actually get good at this. And here's the part most beginners never do the math on. If you're risking 20% per trade, you only need to be wrong 5 times in a row before your account is functionally dead, and 5 losing trades in a row isn't rare. It's a normal stretch that happens to even experienced traders. If you're risking 2% per trade instead, you could lose 10 times in a row and still have most of your account intact to keep trading with. The size of your position isn't just a risk number, it's the difference between one bad month ending your trading and one bad month just being a bad month. Mistake number 5 is not knowing the difference between buying an option and selling one. When you buy a call or a put, your maximum loss is capped at the premium you paid, no matter what happens to the stock afterward. When you sell a call without owning the underlying shares, known as a naked call, your potential loss is theoretically unlimited because there's no ceiling on how high a stock price can climb. New traders sometimes click sell instead of buy by accident, or they don't fully grasp that selling options flips their entire risk profile from limited downside to potentially unlimited downside. Before you submit any order, take 3 seconds and ask yourself which side of the trade you're actually on, because that single detail changes everything about how much you can lose. Mistake number 6 is forgetting that implied volatility can crush your position even when you're right about direction. Say you buy a call the day before earnings because you're confident the stock is going up. The stock does go up 5% the next morning, but your option barely moves, or it might even lose value. That's because implied volatility, the market's expectation of how much the stock will swing, was priced in heavily before earnings and collapses immediately after the news comes out. This is called an IV crush, and it catches almost every beginner off guard at least once. The plain English version is this. The option was already expensive because everyone knew a big move was coming, so once the move actually happens, a lot of that built-in expectation evaporates instantly, even if you called the direction correctly. If you're trading around earnings, understand that you're not just betting on direction, you're betting that the move is bigger than what the market already priced in. Here's what that can actually look like in dollars. Say a stock is trading at $70 the day before earnings, and a call at the 75 strike is going for $2.50, mostly because implied volatility is elevated ahead of the announcement. The stock reports earnings, gaps up to $74, a solid 4% move, and you'd expect your option to have jumped in value. Instead, you check your account and it's sitting at $2.10, down from where you bought it, because the volatility crush wiped out more value than the stock's actual move added. You were right about the direction and still lost money, which is exactly the kind of outcome that makes new options traders feel like the game is rigged, when really it's just a mechanic they didn't know to account for. Mistake number 7 is not checking a stock's options liquidity before you buy. Some options contracts trade thousands of times a day with a tight spread between the bid and the ask. Others might only trade a handful of times with a bid of 80 cents and an ask of $1.20. If you buy at that inflated ask price, you're immediately down nearly 30% before the stock even moves, just from the spread. Then, when you go to sell, you might have to sell back down near that 80-cent bid, which means you've lost money on a trade where the stock actually moved in your favor. Check the volume and open interest before you place a trade, not after. A stock with heavy options volume and a tight 1 or 2 cent spread is a completely different trading environment than one where you're the only person placing an order all afternoon. Mistake number 8 is holding a losing position because you don't want to admit you were wrong. This one is psychological, not mechanical, but it costs traders more money than almost anything on this list. If your option has dropped $120 to $40 and every signal says the trade isn't working, holding on and hoping it recovers before expiration usually just turns a partial loss into a total one. The market doesn't know or care what you paid for the contract. It only reflects what buyers and sellers think it's worth right now. A lot of traders will hold a losing options position far longer than they'd ever hold a losing stock position because the shrinking dollar amount somehow feels less real when it's already down 80%. Treat that $40 like it's still real money, because it is, and decide whether you'd buy that same contract today at that price. If the answer is no, that's usually your answer for whether to keep holding it too. Mistake number 9 is not understanding assignment risk when you're selling options. If you sell a covered call and the stock rallies past your strike price, your shares can be called away from you, meaning you're forced to sell them at the strike price even if the stock is now worth significantly more. This isn't a glitch. It's exactly how the contract is supposed to work, but plenty of beginners are shocked the first time it happens to them because nobody explained it clearly beforehand. Say you own 100 shares of a $40 stock and you sell a call at a $45 strike for a small premium. If the stock jumps to $52 before expiration, you don't get to keep those shares and enjoy the extra run-up. You sell them at $45 like you agreed to. That's not a bug in the system. That's the trade you made the moment you collect the premium, and understanding that up front prevents a lot of confused, angry messages to customer support later. It also matters for your taxes and your timing, because assignment usually happens automatically once your option is enough in the money at expiration. Sometimes even a little in the money is enough to trigger it, and you might wake up the next morning with a completely different position than the one you fell asleep with. If you're not comfortable potentially selling your shares at the strike price, no matter how high the stock goes, covered calls might not be the right strategy for that particular stock. Or you might want to choose a strike price further away from where the stock is currently trading, even if it means collecting a smaller premium up front. Mistake number 10 is trading options without any exit strategy for the entire position, not just a single trade. New traders often treat each options trade as an isolated event instead of thinking about how much of their account is tied up in short-term, expiring positions at any given time. If every dollar you have is sitting in options expiring in the next 2 weeks, one bad week can hurt a lot more than it would if you had a mix of longer dated positions and cash on the sidelines. Zoom out and look at your account the way you'd look at a portfolio, not a single lottery ticket. How much is currently at risk across everything you're holding, and what happens to your account if it all goes wrong at the same time? If that number makes you uncomfortable, that discomfort is useful information, not something to ignore. So here's where I'll actually give you my take instead of just listing problems. If you're new to options, the single biggest lever you have isn't picking better strike prices, it's position sizing. Cap any individual options trade at 2 to 3% of your account, decide your exit before you enter, and give yourself at least 30 days until expiration on anything you buy. Those 3 habits alone will save you from the majority of the mistakes on this list, because most of these problems only become account-ending disasters when they're combined with an oversized position and no plan. Do those 3 things consistently, and you'll have already avoided the mistakes that wipe out most beginner accounts, even before you get good at picking direction. Thanks so much for watching. If this helped you avoid a mistake you didn't even know you were about to make, go ahead and like the video and subscribe for more breakdowns just like this one. Happy trading!